So let's review our tax code right now. How does it currently stand? First item we have to look at is what is taxed as ordinary income? Because ordinary income is essentially the major component of how you pay taxes. And it encompasses a wide range of income. It encompasses your wages, self-employment income, rental, business income, pension, annuity income, retirement account distributions from a traditional plan, right? Not Roth, only traditional. Ordinary dividends and interest. Social Security gets taxed as ordinary income. 15% is tax free, but 85% of your Social Security income gets taxed as ordinary income. Short term capital gains. So, what is a capital gain? A capital gain is an asset that you sell for less, for 1 year or less. You held it for 1 year or less, like a stock, bond, mutual fund, index fund, real estate, cryptocurrency, whatever it is. If you hold it for 1 year or less and you sell it, you're going to be treated as ordinary income in that scenario. If you hold that asset for longer than a year, then you will have a preferential tax treatment. Now, this doesn't apply to assets that you sell inside retirement plans, right? All retirement plans that are traditional are treated as ordinary income on the withdrawal, not when you sell assets inside that account. So this only applies to essentially non-retirement assets, assets held outside of a retirement vehicle. And generally speaking, we're going to see a preferential tax treatment of around 15% on assets that we sell, that we held for a year or for longer than a year, longer than a year. Okay. So let's look at these itemized deductions. Again, very difficult to qualify for itemizing your deductions right now because of that cap of $10,000 per household. So if we got mortgage interest, we got charitable donations, and we got medical expenses that have to exceed greater than 7.5% of your adjusted gross income, it's tough to hit that metric of itemizing your deductions because our standard deduction is so high. And our standard deduction is the greater of your itemized deduction or the standard deduction. That's what you use to deduct against your ordinary income, your adjusted gross income, right? So this is the freebie that the IRS gives you and says, okay, you don't qualify for itemized deductions, take your standard deduction instead. So all of that ordinary income that I showed you would essentially be subtracted by the itemized or the standard. Now, the question is, if we review the four categories of mortgage interest, property taxes, and state capped at 10, charitable donations, and medical expenses greater than 7.5%. Let's give you an example. Imagine if my itemized deductions, right, and I was married filing jointly, right? Let's say my mortgage interest was 15,000. Let's say my property and state taxes, so let's just put taxes, was 10,000. Let's say my charitable donations was 4,000. Let's say my medical expenses did not exceed 7.5% of my income, so therefore that was zero. So my itemized deductions in this example are 29,000. If I'm married filing jointly, am I using my itemized deductions or am I taking the standard deduction? I'm taking the standard deduction, right? It's 30,000. It's greater, right, than 29,000. Now, the next question though is, did my charitable donations of $4,000 even get applied? Not really, because at the end of the day, you took the standard deduction. You didn't take the charitable donation or the itemized deduction. So therefore, pretty much the charitable donation wasn't a tax benefit to you. Okay. These are things you have to know about financially related to your taxes, right? Decisions that come about from that. So if we look at the ordinary income tax rate and how that's basically done, we'll look at kind of the 1040 that you use. Your wages get reported on line 1. Your taxable interest gets reported on line 2B. Tax exempt interest gets reported on 2A. That could be municipal bonds, interest that's tax-free. Ordinary dividends get reported on 3B. Qualified dividends, which gets treated as capital gain tax rate, gets reported on 3A. Distributions from a retirement plan get reported on 4A. The taxable portion gets reported on 4B. So there can be withdrawals out of retirement plans that are not taxable. If there's contributions that you put into an IRA, didn't take in a deduction, you might find in 4B that there's a different number than 4A. Pensions and annuities get put in 5A. The taxable portion gets put in 5B. So the pension and annuity figure that comes from your federal pension is actually not fully taxable. There's dollars that exist inside that pension plan that you put in from your paycheck. And therefore, when you get your pension in retirement, some of that is a return of your own contribution to the pension plan and therefore not taxable. So you're going to see a different number in 5A than you do in 5B on your pension. The exact same is for Social Security. 85% is taxed, 15% is tax-free. Therefore, whatever benefit that is put in here, let's say it's 40K, you might find on 6B that 35K is what's taxable. Okay. You with me so far? Okay. Capital gains. Capital gains get lumped in to one item. I don't know why the 1040 does this, but they combine long-term and short-term capital gains in line 7. Okay. And then other income in line 8 is business income. So in this case, in this example, it was a loss. So what we arrive at is what's called your adjusted gross income in line 11. All the capital gains actually get lumped into this figure, even short and long. The reason for that is it's used to determine eligibility to retirement plans on the outside, whether you can contribute to a Roth IRA, whether you can, Medicare premiums are based on adjusted gross income in retirement, right? But that's not what's fully taxed as ordinary income. So what ends up then happening is line 12, either the standard deduction or the itemized deduction will apply. Because this is a snapshot from previous tax returns when we had a smaller standard deduction right here, right? That's what's being applied. It's the standard deduction in this example, right? And then the IRS will give you a freebie. If you don't itemize, you don't end up itemizing your taxes like in the last example, and there was a $4,000 charitable donation that literally didn't apply, they'll grab 600 of that and throw that on top of your standard deduction. But that is the maximum deduction you can take on charitable donations if you are using the standard deduction. Okay. From that, it's combined here in 12C, and then we have what's called taxable income. So taxable income actually has two components to it. One is going to be your ordinary income, and then second is going to be your long-term capital gains. And essentially what is happening behind the scenes is the software that's being used is it's going to subtract the long-term capital gains from this $173,000 figure. That's going to grab a preferential treatment of about 15%. And the ordinary income that made up that figure is then going to be put on the tax table. And that tax table is right here for ordinary income. Okay. So from here, you determine your tax bracket. It's layered, right? 10, 12, 22, 24, 32. So big jump between 24 and 32. I promised that I would have you look at the tax tables before the job and tax cuts that was in 2018. Here was the rates that we had prior to the 2018 changes. As of right now, these rates that are currently in 25 will expire in 26. This is what the current administration is trying to do, is continue these out, because as you can see, there are bigger adjustments to the tax rate, and there are wider ranges of income currently than what there used to be in those old rates. If you look at the fourth bracket right here, it only encompassed about $70,000 of income. Currently, it encompasses about $180,000 of income and is at the 24% rate versus the 28. So we think at a minimum, these will get pushed out. We don't know if it'll be indefinite, but we think 2030 is probably a sure bet, or potentially longer, okay, to these rates. Um, Obviously, any new administration in 4 years can come in and change them again. It just has to be passed through Congress. So bottom line, we believe we're in a low as it gets tax regime in the current rates versus what they were